Good evening and welcome to How to Protect Yourself from the IRS and Resolve Your Tax Debts. We'll be overviewing a few tax resolution topics, including installment agreements, i.e. payment plans, offers in compromise, and current and non-collectible status. I hope everyone gets at least one useful thing out of this session, and in future webinars, we'll delve deeper into some of these and other topics. My name is Wayne Scully, and I'm a business and tax strategist. I'm the owner of W. Scully CPA PC, where we say taxing you is their job, saving you is ours, or we'll give you $100. With a focus on providing solutions to landlords, flippers, and real estate pros in the New York tri-state area, my firm offers tax compliance, business consulting, and high-value tax plan strategies to save clients thousands of dollars. In a moment, I'll be sharing my screen, but before we get started during the session, feel free to send questions via the chat box, and I'll answer them at the end of the session. If you don't get your question answered today, feel free to email me at wayne@wscullycpa.com. That's wayne@wscullycpa.com. You can find me also on social media platforms, including Facebook, Twitter, Instagram, LinkedIn, and YouTube. And you can send me questions there as well. And also make me smile with a Google review. Here are a few basic rules for our time together. Please mute your mic, give me your undivided attention, post your questions again in the chat box, and you can ask questions at the end, also verbally, and save other questions again to the end of the presentation. Okay, so thank you for that, and let's do this now. Okay. How to protect yourself from IRS collections and resolve your tax debts. Who am I? Licensed certified public accountant in the state of New York. I'm a tax and business strategist, as I said before. And this is what I do all year round. I help clients with various tax and business matters to help them be more profitable and save on taxes. Auditor, I'm an auditor and or former auditor. I'll never stop being an auditor, to be honest with you. And a former bank examiner with the Department of Financial Services. So that experience has given me a lot of insight into compliance issues and making sure that people stay on track so they don't have problems later on with regulators, such as the IRS. If you owe money to the IRS, you're in the right place. You're talking to the right person. I'm going to definitely steer on the right path to make sure that you are, that you do not face the wrath of the agency, right? The IRS is really no agency to joke with. You really want to be on your P's and Q's when dealing with the IRS and IRS agents and so forth. You do have options. You do have options. We're going to go into a couple of those options today, only a few. As I mentioned before, offering compromise, installment agreement, and the status that allows you to avoid them in the short run, okay? Non-collectible status, that is. Two most important rules. File all overdue tax returns, okay? So if you're doing this alone, make sure you file all your overdue tax returns and stop, I say stop accumulating more debt. The worst thing you could do for yourself in this scenario is add new debt to old. And I'll tell you real quickly. A client of mine last year got approved for an installment agreement, payment plan, and then in the 2022 year incurred an additional $60,000 in debt. So what did the IRS do? They basically defaulted, they canceled the payment agreement that was in place. So we had to start the process all over again. They had to re-engage me and pay me more money, and it just wasn't a good situation for them. Ultimately, we got it resolved and they're back on track, but you don't want to accumulate new debt. That I can underscore how important that rule is. You do not want to incur new debt. What is a tax lien? If you owe money to the IRS, they have a lien against you by law. This lien attaches to everything you own. including cash. In fact, there's something called a transferee lien, which means if you give that asset away or you sell the asset to someone else, the money you receive from the proceeds of that transaction, the lien follows, it attaches to that. So anything that every time you convert that asset to something else, the lien still stands. And in fact, I have a client right now, I'll just tell you a quick story. A client right now where, well, God rest her soul, the client passed away. Her son received the property. Actually, the property was transferred to him. It's a real property, was transferred to him prior to her death. And the IRS still wants to collect. So it doesn't go away, folks. And I'll just say again, the lien attaches to everything you own. The IRS may file a public record called a notice of federal tax lien. So that may appear in your credit report, and it may prevent you from getting credit to, say, purchase a home or something like that. So you need to definitely be aware. You don't want to be in a situation where they file liens against you. But sometimes it's unavoidable, but we take care of that for you. So there are different ways, different avenues to take care of liens. If you need a lien subordinated or withdrawn, but ultimately the lien never goes away until you pay the debt. So, and I may have talked a little bit about that already, but yeah, you cannot sell or transfer property covered by the lien, which is everything, without requesting a certificate of discharge. You're not supposed to. Sometimes it happens, you're not supposed to. When refinancing real estate, you must subordinate the lien to the new mortgage. So the IRS will take first position. If you're not clear on what that means, when you subordinate the lien to the new mortgage, the IRS takes first position. Typically, the mortgage company has first position, first preference, which means they'll get paid first if the person walks away. But in the case where you refinance, the IRS will allow you to refinance, and you'll have to give them first position. They also want to get paid. If it's a cash out refi or something like that, cash out refinance, the IRS is going to want to get paid at the table. So expect that as well. And again, as I said before, don't expect the lien to get completely removed. The only way to really do that, really, to be honest with you, is by paying off the debt, or the debt expires, something like that. So, and then even after that happens, you have to make sure that that documentation is filed with the appropriate third parties to give notice that the lien no longer exists. What is a levy? It's the actual taking of money. So the IRS has the power to levy your bank accounts and paychecks. That's called a wage garnishment. And your accounts receivable, if you're in business, the IRS can actually levy your accounts receivable. They can take the money from the third party that owes you, who owes you cash or whatever the asset they're exchanging for services, and they can actually have those assets redirected to them. So you don't want to be in that situation either. But again, sometimes these things happen and there's a fix. There's always a fix. Well, those are some of the common levy sources: bank accounts, paychecks, and accounts receivable. Why was I levied? It's really a wake-up call. So a lot of people, when they have IRS debt or state debt for that matter, just so you know, a lot of these issues I'm discussing pertain to the IRS. However, there are many people with state debt. In fact, most people with an IRS debt also have a state tax debt. So there's really, when they levy you, it's really, they're shaking you up. They're saying, hey, we need this money right now. Or listen, pay attention to us. You know, we've been sending notices, letters, and so forth in the mail. You have not been proactive about responding to these notices. And so we're going to take some proactive action to protect our position. And so that's your wake-up call. And so you always need to respond. You should definitely respond to IRS notices once you get them, and do it on time. There are windows, there are time frames in which you have to act. If you don't act, you could lose your rights to do certain things. So respond on time, return phone calls from IRS personnel, but verify that they really are from the IRS, because there are a lot of scams happening these days. And the last thing you want to do is give a third party who does not work for the IRS your personal identifiable information, such as social security numbers, dates of birth, and so forth. But the thing I want you to take away from this slide is never ignore the IRS. Never, ever ignore the IRS or the state. Never do that. And if you're not sure how to handle that situation that you're in, you're not sure how to interpret the notice that you received, definitely you should call someone like myself who has expertise to review that and give you proper advice to get you on the right path. More about levies. Levies can be appealed through a special process, and levies can be released. So if you can demonstrate a hardship, if you know you're looking, that money is to pay your rent, you're going to be kicked out of your home if you don't pay your rent or your mortgage or something to that effect, we can make a case to get the levy removed and even sometimes get money back from the IRS and or state. So expect to provide a lot of financial information about yourself. It'll feel just like going through a mortgage loan application, right? It's very invasive. So just be aware of that and be mindful that you will have to provide a lot of information. Lucky for you, I'll be collecting a lot of that data. If you were to hire me, let's say, I'll be collecting a lot of that data. I'll be synthesizing that data to make sure it's things are properly illustrated in the forms that we send to the IRS, and that you're on the right path. So banks must hold funds for 21 days before sending to IRS. If we can intervene within that period, we can, again, possibly get that money back. Okay, so what are your options? These are the big three options to resolving your tax debt: currently non-collectible, installment agreements, and offers in compromise. There are other ones, of course, but those are the major ones, right? And depending on your situation, your specific situation. Currently non-collectible status, called status 53. If you have negligible assets and no income beyond what is required to live, you may be eligible. Also, typically I've seen where clients of mine have been unemployed, they've not been able to get employment, and it's been a while that they've been unemployed. It's easier to get this status for those folks. Right, so current non-collectible status, and you see the negligible assets. It's highlighted in red, or it's the font is red, and that's very important. So you can have a home with a lot of equity in it, or you can have a really expensive coin collection. You can't have that stuff. So because they're going to say, hey, why don't you sell those assets and pay us some of our money? So. And of course, you can't have income above a certain amount that'll make you not eligible. So the creation of undue hardship for you, leaving you unable to meet necessary living expenses. So if they're going to take your home and or they're going to take money from your account, and that would create a hardship for you where you can't survive, you can't eat, you can't afford to live anywhere, then you may be eligible for non-collectible status. Oftentimes the IRS will try to locate your assets, and if you have no assets, I'd say again, I always tell clients, be upfront, because if you do have assets and we lie in the form, that's an offense. You don't want to do that. So you want to be upfront about what you have, and they will search, and if they can't find the assets, that's another eligibility factor. And oftentimes the IRS is well, not oftentimes, but in some cases, the IRS is unable to contact the taxpayer, and if they can't do that, they'll put you on that status as well. There's more about eligibility factors. You die with no significant estate left behind, so you die basically broke and poor. So you're gonna go on that current non-collectible status, and maybe it even gets better for you. So. Okay, so and then bankruptcy or suspension of your business activities with no remaining assets, that makes you eligible as well, or those two factors make you eligible. So if you're in bankruptcy, yeah, they'll put you in a status. And some special circumstances, such as tax account of military personnel, serving in a combat zone. So not enough just to be in the military, you have to be in a combat zone to be eligible for the CN, as we call it, CNC status, currently non-collectible. Things to keep in mind. You'll be required to provide full, as I said before, full financial documentation. They want to know about your income, your expenses, your assets, your liabilities. They want to know it all. You know, what you spend on, toiletries and, and stuff like that. So you're going to have to disclose everything about your financial life. So, and the status will generally last for 1 year. So what happens is every year they revisit your case to see if you've now become ineligible or if you're still eligible. So let's say you start working during the course of the year, then they're going to take you off that current non-collectible status again, or at least they'll ask you to provide new financial data to see if you still qualify. Because you could work, you could still be working, but if you're only working enough and making enough money to pay your, expenses, your living expenses, your ordinary living expenses, then you can't pay them either, right? So, but generally speaking, they revisit this once a year. Sometimes it takes them 2 years to revisit this, but they do. And just so keep it in your mind that they're going to revisit it. So yeah, as I said before, the annual reviews could change your status. It could be where they say, you know what, you're no longer eligible for this status and we're taking you off. Penalties and interest continue to accrue. They don't go away while you're in the status. Penalties and interest still add up. And again, depending on what type of penalties you're being assessed, it could be 4.5%, 5%, and even higher. So just be mindful of that. It adds up really quickly. Tax lien will not be removed. They don't remove the liens while you're in this status. So don't have that expectation. The lien stands until, like I said before, the lien is removed. And usually that means you've paid the debt or the debt has expired. Well, now the cool thing about current non-collectible status is if you're, depending on how old the debt is and how close you are to the expiration of the debt, if you can get on the status, you could potentially save yourself a lot of money, a lot of headache. So just be mindful of that. If the statute expires relatively close to when you are put on this status, you could potentially save yourself a lot of money, right? Because you will only have to pay until the statute expires. Let's talk about installment, IRS installment agreements, AKA payment plans. What are the benefits? So all the nasty collection activity, the letters that you get, they run in cycles, by the way. Those letters that you get periodically, if you owe money, those letters stop. Okay, while you're being reviewed for the installment agreement. While you're being reviewed for it, and it may take a couple of months. These days, it's taking a while because of the backlog with COVID and everything. So it's taking a while. But while that's happening, you're not going to be getting letters. So they're not looking to collect either while you're being considered for the installment agreement. And you could get liens, potentially get liens removed under certain conditions, and potential automatic penalty reduction. So there are options when it comes to penalties. There's a first-time abatement of penalty, and there's reasonable cause penalty abatement. So there are options when it comes to penalty when you are on an installment agreement. And seasonal adjustments can be made. So sometimes, depending on the type of installment agreement you get, sometimes you get a smaller payment in the beginning, and it's tiered, so it changes over time. And sometimes that's good because maybe you don't have a lot of money now, and you want to be on the payment plan, you want to do the right thing. And so if by starting out on a low payment plan, it makes it better for your budget, then by all means, you should definitely do that, or at least think about that option or request it. And again, you may not have to pay the full amount that you owe, depending on when you get installment or what type of installment agreement you get. You may end up only paying a fraction of what you owe up to when the statute expires. So just bear that in mind. Downsides to installment agreements. There's a setup fee, and depending on who you are, I just had a client that a few months back, she got approved. Her fee was $0 because she was considered below the poverty line. So based on her household size and whatnot, she didn't have to pay anything to get any fees to the IRS. But typically there are fees to set these up. And there's a fee if you do it alone online versus if you do it with an agent on the phone. It gets more expensive that way. And again, you may need to, like with the current non-collectible status, you may need to provide extensive and invasive financial information to the IRS. Again, your income, expenses, assets, liabilities, they want to know everything. And again, I encourage you to be upfront with them, because if they catch you in a lie, it could potentially spell trouble for you, right? You're signing off on the penalty of perjury, so you don't want to do that. Mandatory monthly payments are required when you're in an installment agreement. That's the whole point. It's an installment agreement. It's an installment plan, a payment plan. So you're paying a certain amount of money every month, okay? And sometimes I've had clients where they say, well, I don't want to pay every month. I want to pay every 2 weeks. And they work for someone, they're employed, they're an employee. There's a certain form that you complete to have your employer take the money out on your behalf and send it to the IRS. So that's an option as well. Penalties and interest still accrue. As with current non-collectible status, penalties and interest still accrue. And you may have to keep paying until the statute of limitation runs out. So once that what we call CSED, collection expiration, statute expiration date, once it hits, then you won't have to pay that anymore. So if in some cases you will full pay the debt, and in other cases you will not full pay the debt, meaning you will not pay all of what you owe, which is a good thing. But you gotta get this thing set up right. You gotta seek counsel and get the right people on your side. If you want to go it alone, you can certainly do so, but I don't advise that. Types of installment agreements. Guarantee installment agreement. You have your streamlined installment agreement, and in-business trust fund, and the in-business trust fund regular. So these are only there's a partial pay installment agreement. There are other installment agreements out there, but these are some of the more common ones. The first two are for individuals, and the individuals and businesses, and the other two are for trust fund issues. So when you owe IRS, if you have a business and you owe them for FICA, that FICA covers it covers the Social Security and Medicare taxes. You're gonna most likely get an in-business trust fund or an IBTF regular. So regular installment agreement. Partial pay, as I mentioned before. And you can do all these through a direct debit. So direct debit, IRS loves those because they get to dip into your account and take the money out every month or whatever, and they pretty much can guarantee they get their money. Of course, if you have no money in the account, then that's another issue. You should strive not to have that happen, because if you miss the payment, you potentially could default an installment agreement, and you got to start from scratch. So pending status, if you have a pending installment agreement, which is probably pending a manager's review, depending on the dollar amount of the installment agreement, it could be put in pending status to be reviewed by a manager, to be approved, and so forth. So that provides you some protection, because again, once it's in that review window, they're not sending you notices and so forth. So to request an installment agreement, you got to provide your PII, personally identifiable information, like your social security number, like your date of birth, like your name, of course. Identify the tax liabilities that are going to be covered, proposed payment terms, what you'd like to pay, and have no on-file returns, and be up to date with your estimated tax payments for the current year. So estimated payments could be withholding at your job if you're a W-2 employee, or it could be estimated taxes if you're self-employed. So just be mindful of that. You cannot, again, I mentioned earlier, you don't want to pyramid your debt. You don't want to add new debt to old, and you certainly want to be current. You want to be current with your tax filings. You want to, besides that, if you're current and you're getting a refund, why have the IRS hold on to that money, right? So it's really, really, really critical for you to not have any unfiled returns and be up to date with your estimated tax payments. So negotiating your installment agreements. Remember, you must be up to date with all tax returns, as I mentioned before, and current on your estimated tax payments. You can request your installment agreement by mail, fax, voicemail. Now, to expedite it, I always do it by voice, by phone. I'm not sure we have voicemail here. I probably should change that. But by voice, I can, because you can't leave a voicemail for the agent and have them process that. You have to actually speak with someone, right? So you can mail the forms and you could fax it in. Of course, you want to ideally fax it to a representative as opposed to just faxing it to a general number. But my preferred method is to call the IRS, right? Now, if you try to call IRS on your own, it can take a long time to get through. If you hire someone like myself to handle this for you, we have channels, we have ways to get to them a little faster. Now, I typically love to do them by voice because I get an immediate, sometimes depending on the type of installment agreement, I get an immediate approval of that installment agreement. I could take it to that client, and usually they're pretty happy, right? It's done, it's one and done. We're all set. They can start looking at this stuff behind them. Now there's a form IRS 9465, IRS form 9465. We never use these. It's a very basic form. It's usually a part of the if you've ever used tax software, it's a part of the tax software package. It's a form you can download from the IRS website. In fact, you can download any of these forms from the irs.gov website, but it's limited in the things you can do. So I would not suggest you do that. Again, if you have a situation that warrants speaking to someone, you should speak to someone regardless, just to know your options. But don't just go ahead and complete 9465. We never use that. As tax professionals, we don't use this form typically. And you got to specify the type of installment agreement that you'd like to have. Tiered agreement, partial pay installment agreement, regular, trust fund, you name it, right? So you have that option. Okay. Doesn't mean you're going to be approved for it, but you should definitely ask. Doesn't hurt. Trust fund recover penalty and assessment expiration date waivers, form 2750. Never sign the forms from the IRS collections without advice from an expert. The IRS wants you to sign something. You don't want to sign away your life, right? You don't want to sign away other options you may have that could get you out of a bind. So speak to someone like myself before you sign any forms from the IRS, okay? Be ready with your necessary financials. You may or may not need to provide various supporting documentation, and you may or may not be required to apply for loans against your property. So what that's saying is there are certain things the IRS may hone in on certain aspects of your financial life, that they want more information about. So typically, I don't send all the supporting documentation to the IRS. I wait for them to send back a request, whether they may call me up and say, hey, we need to, we need updated W-2s. We need, some particular item of expense that doesn't seem right. We need you to provide support for that, okay? I've had them question my fee. I put my fee, yes, my fee. If you pay me, if you hire me to do this work for you, that fee gets to be included in the form as an expense. So, and they questioned that, and they wanted more information. I had to send them a contract and proof of payment from the client and so forth. So it's on a case-by-case basis. Depending on the agent and the nature of your installment agreement, they may ask for more, but I don't just send them all the information. I don't do that. And as far as applying for loans, sometimes if you have equity in your home, if you have equity in an asset, usually real estate, they will ask that you apply for a loan. Now, if you do have tremendous amount of equity in the asset, they could potentially take some of it and apply it to the debt. Now, if you can't, if you apply and let's say your credit is shot, you don't have good credit rating and no one will afford you a loan or honor your loan request, you have to provide documentation to the IRS that says, hey, I tried 5 banks, or I'm just throwing it on. Let's say you have to go and try 5, but I tried a couple of banks and they won't approve me for a loan. So therefore I can't tap the equity in my home, which is a good thing. It's a good thing because, if, or it may be a good thing because if that's the only thing they're looking at and you're close to the debt expiring, you could end up not paying anything, right? At all, even though you have your home. And by the way, typically the IRS does not kick people out of their homes. They don't do that, especially if it's your residence, your permanent residence. If it's your domicile, they don't kick you out of your home. They don't do that. It's just not good optics for them. And you got to include all your tax types and periods, whatever you owe that's on your name. And usually you'd know what you owe if you pull a transcript or individual master file on your account. You'll see everything. And when speaking to the IRS agent, you could ask. But I will always follow up. I always follow up with an actual request for the transcripts for all the years, because I want to see it for myself. I want to review it. That's part of what we do. We review the transcripts, make sure that your liability is it's what it is supposed to be. Make sure that charging an additional interest that they should not be, or any penalties that they should not be. That's what we do. So it's not just about us putting stuff on the forms and submitting to the IRS. We do a deep dive into your tax debt and into your financial life to see what expenses we can legitimately and legally increase, or maybe there are expenses we can add to get you the best deal out there, or somehow lower your income. Again, legally. Helpful tips. I just mentioned this before. Have you maximized your allowable expenses shown in Form 4? Form 433 is a form you submit that shows, or it's a financial collection statement that shows there's all your financial information. From a bird's eye view. And if they want more details, they'll ask for support and documentation. So that's what that form is. Have you minimized your income within legal parameters? That's something that you definitely need to think about. How can we shift income legally so it doesn't affect you in this scenario? Have you already tried to borrow money against your assets? I mentioned that before. If you have equipment or some car that's worth a lot of money, and usually it's real estate, right? If you have equity in your real estate and you could potentially tap it to pay them, if you can tap it to pay them, I definitely would recommend doing so. In a lot of cases, again, depending on where you are on the debt, how long before the debt expires, there are a lot of factors to consider. But it sure as hell beats paying the IRS high interest on the debt that you owe them. If you can get a real low interest rate. I know we're in a rising interest rate environment now, but we have to do the analysis. We have to do the analysis to see whether it's best for you to tap the equity and pay them, or just not do that if you can. If chances are, if you're credit worthy and a bank will lend you, you're probably going to be forced to do so. But before you do that, talk to a professional. Never be afraid to ask for anything. I mean, the agents, or from me, if you're dealing with a tax professional, never be shy to ask for what you want, and take care of all your tax accounts at the same time. No sense in doing 3 years and have the 3 other years outstanding. You have to start the process again to add those years, those tax debts to your agreement. Let's talk about offers in compromise. Offers in compromise. You hear the ads on TV, or you see the ads on TV, you hear the ads on the radio. They talk about pennies on the dollar, and they make it look so rosy and nice, as if everyone can be approved for this. And the fact of the matter is that statistically, you have a better chance of being approved for an installment agreement or even a current non-collectible status, because the numbers show that most offers, less than 1%, way less than 1% of offers get approved. Okay. So anyway, it is an option. It is an option. It's not an option for everyone, but it is an option. And it's worth surveying. Settle tax debts for less than what you owe. Eliminate your penalties and interest. No levies, and no limit to the amount that can be settled. So there are no levies, and there's no limit to the amount that can be settled. So if you owe them $10 million, you could potentially settle $10 million in tax debt for pennies. What is it? Relatively speaking, that is. Okay. So, and once you settle the debt and pay them off, you don't have to worry about the penalty and interest, because that's a moot point. They no longer exist. They're not relevant anymore. Other benefits. The goal is to achieve collection of what is potentially collectible at the earliest possible time and at the least cost to the government. And to you, of course, right? So the government cannot later, once they approve the offer, right? Once the cool thing about once they approve it, they cannot reopen the case to, say, hey, now you can pay us. So let's have the money now. They can't do that unless there's evidence of fraud. Now, if there's fraud, and that's why I told you at the top of the hour, if you owe them, when you're gonna complete the financial collection statement, you need to be upfront about everything you owe. You got to disclose all your income, all your assets, okay, and definitely disclose your expenses. Although you should know that all expenses will count towards getting you. In the case of an installment agreement, all your expenses will count. Certain expenses will not count, and if the expense is extravagant relative to your situation, that may not count either. There are exceptions to every rule, of course, but so they cannot later reopen the case. And if you meet the low income thresholds, they may waive application fees. I thought about that earlier, where a client, she got an offer, and they waived the fees. They waived their application fees and down payment as well. Just so you know, by the way, that client that I'm speaking of, she got a sweetheart deal. She owed the IRS $245,000. I was able to negotiate with the IRS agent. They wanted her to pay $30,000, right? They came back. The original offer from us was $5,000. They came back with 30. I was able to successfully negotiate down to $20,000. And I talk about this on my YouTube channel. I talk about, on my website as well, www.wscullycpa.com, that, how I kind of, walk this client through, discussing with her, at the end, when everything was resolved. I kind of updated her on the case, and she was so elated that we were able to resolve this for her. But yes, she was a low income qualified taxpayer, and she had fees waived, and she got a sweetheart deal. She saved herself, and it's a trust fund penalty case, by the way. She owed FICA taxes, or a company owed FICA taxes. But the beauty is, again, we saved her $225,000. And I mean, that was a shining moment in my life, and it was definitely a great time for the client as well. She was very, very happy. So the reason of alternatives to when the offer and compromise doesn't work for you is, again, installment agreement or non-collectible, we call current non-collectible status. Those are the options that will work, should work, or may work, depending on your situation, if you don't qualify for it. But I remember I said before, offers are not easy to get. They don't just fall from the sky. In spite of what you hear on the radio, I really want to underscore this. In spite of what you hear on the radio, and you may see on TV, most on the radio, most people will not get an offer and compromise. Okay, for one reason or another. Sometimes people can't pay the deposit, because there are two ways that the offer and compromise works, right? it's where you have to put a 20% deposit down if you're paying it off in 6 months, or you can pay it off in 24 months. Okay, so if you take the 20% down option and you can't come up with the 20%, your offer and compromise is going to die. Okay, dead on arrival. Downsides to an LIC. Okay, again, 20% down. Okay, that's going to be due at once, typically, right? Shortly after you agree, it's going to be due. Shortly after it's approved, you're going to have to pay that large deposit, a large cash deposit, right? And there's an application fee if you don't qualify for a waiver. And just so you know, a lot of people don't know this. If you have a refund coming in the subsequent year, they could actually take that refund to pay towards the debt. So it's really good for you to strategize on how you're going to legitimately, legally avoid getting a refund. Okay, there are ways to do that. So talk to a professional like myself to disclose that to you, but there are ways to do that. Full financial disclosure. You gotta tell them again about all your assets, all your income items, your expenses, and your liabilities. Okay, they're probably more concerned about, well, of course, you don't want to overstate your expenses and your liabilities, right? Okay, but they're also going to be looking at your income, right? And they're going to be looking for additional income. So if you lowball your income, they're going to be searching. So you really, folks, I can't underscore this. I mean, I just can't underscore it enough. You need to make sure that you are upfront and honest when you complete that 433 form. It's 433 A and B, depending on whether you're a business or individual. But you got to make sure, you must make sure that you're upfront and honest about what you own and what you owe and your expenses and so forth. You got to do that. Okay. And any payments you make, they're non-refundable. The IRS will keep that. So if you make a down payment and you can continue on with the offer and compromise, they're going to take that money. Okay. Which, I mean, it's kind of like a downside, but it's still, I mean, it's going to go towards paying down your debt. So, you know, it's a downside, but then it's not a downside. More downsides. It extends the statute of limitations. So remember I spoke about there's a certain window from the point they assess the tax, not from the point when you should have filed a return, because if you're a late filer, and that's why it's so critical to file your returns on time. If you're a late filer, the clock starts ticking when you actually file the return, or in fact, when the IRS processes the return. Okay, so the IRS takes a couple of weeks to process it. That's when the clock starts to tick, and you have a certain window, 10 years, they have a certain window to collect that tax from you. Okay. Now, when you are being considered for an offer during that period, it extends. It's going to toll or stop the clock, which means the date gets pushed further into the future where they can collect from you. Okay, that's really important to know. And then the IRS is going to look at your returns. They're going to look at your tax account with greater scrutiny over the next 5 years. They're going to look at your tax account with greater scrutiny over the next 5 years. So that's one of the downsides, right? So you got to make sure you cross all your T's and dot all your I's on your tax return. Make sure all your deductions are properly supported. Properly, I'm not going to go into the intricacies of that, but make sure your deductions are properly accounted for, so that if they come and ask a question or questions of you, you'll be able to provide not just the summary document, which is tax return. There's some summary schedules as well, but you can provide the source documents that show that you are eligible to take those deductions. Non-tax liabilities cannot be settled. So if you owe child support or something like that, or some judgment to some other agency, or you were taken to court and someone sued you and won, you cannot settle those, at least not in this form anyway. Okay, so child support for sure, you cannot settle it through this process. And IRS lawyers will look at liabilities over $50,000. So that's an extra pair of eyes that will go to look at your return. Not just a manager, but a lawyer will look at that. Okay, so again, that's why it's important to be upfront and honest about everything. Okay, very, very important, because if they catch you in a lie, it could spell trouble for you. Here are the requirements. No, tax liabilities will not be reduced to judgment. You can't have that. The tax liabilities that your tax liabilities may not have been reduced to judgment. No restitution orders, no pending litigation, criminal or civil, in regards to tax periods in question. So none of these things can apply to you if you're going to get an offer. Okay, and it must include all your tax liabilities for federal, and again, they're offered in compromise options when it comes to states as well. I know New York definitely has it. Most states have that. And by the way, talking about statute of limitation, let's go back real quick. Most people don't know this. New York, if you're in New York, which is where I am, New York statute of limitation and tax debt is 20 years. IRS is 10, New York is 20. So you don't want to owe New York, because you're gonna wait a long time for that debt to magically disappear. And for Maryland, for example, which is really extreme, they go into perpetuity. It never expires. Okay, the tax debt never expires. It stays with you until you're dead. They'll attach it to your estate as well. I'm sure they will, if they have an opportunity, if you leave enough assets behind. So just be mindful of that. Try not to owe Maryland. Okay, New York maybe, but definitely not Maryland. So we talked a little bit about payment options earlier. Lump sum cash offer, 20% down. I mentioned that before. No more than 5 additional payments within 5 months of acceptance. So once they accept it, you pay the 20% deposit. You pay the deposit with the application, by the way. And then once they approve it, you have to make the remaining payments. And this is a lump sum offer in 5 months. Okay. No payments are required during the evaluation process. So you don't have to make a payment while they're reviewing your case to see if they'll approve you. And for periodic payment offer, which is what my client got on the $20,000 tax debt. And this, like I said, folks, I can't stop talking about it. I was so happy for her. It's such a big win to save someone $225,000. It's huge. Now, periodic payment made with the offer, you got to make the first payment of the offer unless you qualify for low income status, and the monthly payments during the evaluation, maximum of 24 payments are allowed. So you can't go beyond 2 years with this, and payments are not returned if your offer is rejected. If your offer is rejected, none of your payments, whether it's a 20% down or the 1 month payment you're going to send it with them for a periodic payment offer, you will not get that money back. Like I said, it sounds bad, but it's going to go towards your debt, and it's not, it just goes away. It goes towards your debt. So at least you've paid something towards it. Reasonable collection potential. That's IRS lingo. They look at your assets, your income, to see what the minimum offer would be, and that's the analysis that we do as well as professionals. We again, once we maximize your expenses and minimize your assets legally, we then look to see, once all that's done, we compare the assets and the expenses to, the assets to the expenses and the income to the expenses, and we see what's left, and that's going to be the minimum offer amount. And it cannot be zero. You have to make an offer. By the way, the minimum offer amount is ideal, but there may be extenuating circumstances which may allow you to make an offer less than that. Okay, but your offer, under no circumstances can your offer be zero. Okay, it cannot be zero. And it doesn't include any amounts you've already paid. You can't say, okay, well, Iris, I paid you 5 months ago before we started this offer process. I paid you $10,000. Can you count that? It's not going to be counted, okay? It's going to reduce your debt, so it does impact it, but it doesn't get counted in the reasonable collection potential calculation. Minimum offer is the total amount of all these monies. The minimum offer is the total amount of all these monies. As I said before, whatever is left after you take out, if they extract your expenses, your legally maximize expenses from your income, that's the offer. Okay. Or look at your assets after you subtracting the liabilities against those assets. That could potentially be your offer. Okay. Real estate, for example, you have equity in the real estate, and again, it depends, because sometimes multiple people own a piece of real estate, and they have to factor that in as well. So they won't say take the entire equity that's there, because if it's owned by two folks who are not a part of that tax debt, let's say they're not married, you own property with someone else that's a business partner, for example, they can't just take a fraction of the entire equity. They can't do that. Okay. The total amount the IRS could collect from you within 2 years. So that goes into the reasonable collection potential. What's the total amount they can collect from you within 2 years? Okay. Again, net equity in assets including unseizable assets. So if you have an asset they have not seized or they cannot seize, that's factored into the assets that they could do the calculation on, or we're going to do the calculation on. By the way, if you hire someone like myself, I'm going to determine what your net equity in assets is, and then we're going to make the case for what you're going to offer. Present and future income, they look at that for 1 or 2 years. I'll tell you a quick story about a client of mine that had a business, owed the IRS something like $24,000 because of COVID. The business was shut down. It was a daycare business in Brooklyn, and he had to shut it down. So because obviously there are mandates for him to shut it down. So he shut it down, had this debt coming in from the IRS, right timing, right? Perfect timing. And, he couldn't pay. So, and he wasn't willing to shut the business down at that point in time. So the IRS said, hey, basically, COVID is not going to be around forever. So you're going to there's a potential for you to have income in future years, and we won't accept this offer. So we're currently looking at other options to see what we can do for this client. But really what the client should do, and I'll tell you this, the client should really shut the business down, because he told me he has no plans on staying in the business long term. He's about to retire. So shut it down, shut down the business, and then we can revisit making an offer to the IRS. But sometimes, you have to listen to your professional. They know much more than you do for the most part. Amounts collectible from third parties and value of transferred assets. So talk about accounts receivables. They look at that. If you have receivables that are due to you, they're going to look at that as part of calculating the reasonable collection potential. We're going to look at that as well, if you hire me, of course. Okay. Processability. You must be current and compliant. The look back period is generally 6 years. The IRS can look back 6 years to make sure that you file all your returns. And they can go back even further, but typically 6 years, sometimes it's 3 years, depending on your specific situation, depending on the agent, but generally it's 6 years. Existing levies and levies stand. New levies, generally, they are prohibited, but there are exceptions. And for trust fund offers, the trust fund must be paid, or it must have been assessed. Okay, and if you're an individual that owns, let's say you file a Schedule C, you have a limited liability company or a sole proprietor, it must include the trust fund penalties on that 433. That's actually going to be on 433A, the collection statement for that. Okay. Processability issues. The offer in compromise is filed solely to delay collection. It will be instantly rejected. If they get wind of that, they're going to reject it right away. You have to have a solid basis for that. Okay, you can't file a frivolous offer in compromise. Missing application fee or payment, they'll send it right back. It happens. They'll send that application right back if you don't make the payment. Again, if you're low income qualified, you don't need to make that payment. Bankruptcy filing, that's going to be an issue. They can't process the offer in compromise while you're in bankruptcy. Once the bankruptcy cools off, then you can move forward. But once you're in bankruptcy proceedings, your case is in the bankruptcy and it hasn't been discharged, your debt has not been discharged, they'll not be able to process the offer in compromise. By the way, a client of mine going through with a bankruptcy situation was not able to file the offer in compromise, and we had to wait. So it's really critical for you to make sure that what you want to do really is you want to make sure that the bankruptcy attorney, in collaboration with a tax attorney or a tax professional like myself, a CPA who works in this area, needs to look at the transcripts to make sure that their rules are on bankruptcy, right? And discharging tax debt. Not every tax debt is dischargeable, but you ought to look at that option if your debt is dischargeable. So that's something that the tax professional would be able to tell in collaboration with the bankruptcy attorney, but it's something definitely that needs to be surveyed. Okay, but if you're in bankruptcy, even in active bankruptcy, they will not be able to process that. You have to complete the form 433 and provide supporting documents. Again, I don't always send all the documents. I don't do that. I'll send the baseline documents that's required on the 433, but I won't send everything. Okay. If not processable, you will receive a letter as to why. Okay. There's an investigation process. IRS verifies everything on your report, looks for more. They're assuming you're lying, so they look for assets. They do a search. They search DMV records. They want to know everything. So don't lie. Tell them everything. Don't omit anything. Tell them all your assets, all your income, all your expenses, and all your liabilities. They usually look at, they ask for bank statements. They look at 3 months bank statements, 2 months pay stubs. They'll ask for that type of stuff. Sometimes if you're a business, they'll ask for your financial statements, which is part of the 433 as well. If you're missing information, you'll receive a letter demanding it. So please provide all information that's required. And they verify your assets, look at DMV records, UCC filings. If you're a business, they look to see if you have any assets out there. Or look for real estate, look at pacers for bankruptcy and that sort of stuff. Credit reports for recent loans and credit applications, they ask you for that. Valuation verification, they look at KBB of your car, look to see how much your car is worth. Realtor reports for real estate, and they'll visit your business. If you're a business and you're in operation, they'll visit your business. So just be mindful of that. Wage and income verification, third-party contact, internal system. They look at what was filed with them by people reporting, 1099s and W-2s and other information returns. Look for financial summons. This is all to verify your income. Okay, wages, especially wages, for sure, that's easy. And even with contractors, you get 1099s, they're required to file that, and they'll look for that. Okay, that they're looking for income. And they'll look as far as asset valuation goes. Again, I talked about minimizing your assets. We can help with this. Maximize your expenses. We can help with this. So make sure that you speak to a professional. If it comes to owners for you, speak to a professional like myself. You think you can handle it? You probably can't. So speak to someone about it so you can get the proper representation. If anything is missing there, so we'll contact you. Respond by the deadline. Post-offer responsibilities. Must file all returns on time, paid in full for 5 years. IRS will keep your following your refund. I mentioned that before. Penalties and interest still accrue until the offer terms are met. Fail to meet offer terms or reinstate full liability. Tax liens stay in place until paid. And helpful tips: have you maximize your expenses, have you minimize your income, don't add your assets, accept the personal assessment, take care of all your tax accounts at the same time, and include all your financial documents with an initial offer. Okay, so I'm kind of running out of time, folks, so I'm kind of going through these real quickly, but you can reach out to me, at any time you want. The penalties and interest are charged based on the tax amount that's due or that's owed, and penalties are settled in OIC, in offer and compromise, and penalties can be reduced or eliminated under reasonable cost criteria for installment agreements. Here's some examples. If you have serious illness, you may be able to qualify. If, let's say, someone embezzled money from your company, these are all examples of how you can show reasonable cause to get penalties abated. Okay. Need professional, let me conduct the research for you, and so you know your options. Investigate your liabilities, what we do, full financial analysis, and it's only $4.99 for that. Okay. So, need help? Let me know. I know we're at time, and I'm sorry to keep you over, but I kind of went a little bit over here. My website again, www.wscullycpa.com. That's my phone number. Take a picture of this slide so you can contact me. I can be found on social media: YouTube, Twitter, Instagram, Facebook, LinkedIn, and you can book an appointment there. So I don't know if anyone's still around. I'll be happy to answer any questions anyone has. I don't see any questions in the chat. I don't see any questions in the Q&A. Does anyone have any questions they'd like to have answered? Or okay, Damon raised his hand. Okay, let's see. How do I work this? Okay, sorry, I'm a novice at okay. Damon, are you able to unmute your mic? Or if you can just put the question in the chat, that'd be great, because I can't seem to figure, I'm having some technical difficulties here. I can't seem to figure out how to open can you, okay. All right. Oh, where's my office? So my office is in Forest Hills. I work remotely for the most part, but I do meet clients in my office in Forest Hills. Again, you can look at the Calendly here and book an appointment. If you can't find an appointment that works for you, definitely, send me an email or give me a call, and I'll be able to work on an alternate arrangement with you. Okay, so thank you for that question. And I'm not sure why I can't, okay, all right. So attendees, okay. All right, so, all right. I'm allowing you to talk now, Damon. If you still have questions, you can definitely unmute yourself and speak, but I think I answered your question just a minute ago. Does anyone else have questions? I'm here. I know we're over time, but I'm willing to stay another couple of minutes to answer any questions you may have. Any comments, any concerns, anything you're not clear on, please feel free to ask. And if you don't want to ask in this forum, certainly send me an email, give me a call, or book an appointment. I have 15-minute free appointments that one can book to talk to me. So anyone else with a question? Okay, I think I see another question here. Let's see. Okay, yeah, you're welcome, Damon. You're welcome. So, like I said, you can book an appointment on my using Calendly. There's the link. I want to move this out of the way. You can book an appointment here. Just type it into your address bar. It's kind of, it's not, it's not the easiest, but that's what they gave me. So book an appointment there, and so we can talk. Whatever your needs are, I'll be happy to do a consult with you and give you some useful information if I can. So feel free to do so. I appreciate you coming out. All right, folks, if there are no more questions, I'm going to wrap it up. If there are no more questions, I'm going to wrap it up. And again, you can reach me through my website. Give me a call. You can email me here, wayne@wscullycpa.com. You book an appointment on my calendar. And I do get social, so you can definitely reach me via social media as well: Twitter, LinkedIn, Facebook, YouTube, Instagram. Okay, so thank you very much for attending. I appreciate you guys so much. Thank you for taking the time out. I hope you at least got one takeaway from this presentation. And if you have any problems, if you know someone with a tax problem, definitely give my information to that person and have them contact me. Okay, so with that, I'm signing off. Again, it's Wayne Scully, owner of W. Scully CPA PC, tax and business strategist. Here at W. Scully CPA PC, we say taxing you is their job, saving you is ours, or we give you $100. And I mean that. So far, I haven't had to give anyone $100. I like to keep it that way. So, folks, until next time, take care and all the best. Signing off.